Welcome everyone to Daily Bread with Tom Hartman. That's right, your one and only Daily Bread. I was supposed to be here yesterday. I was all excited to be here yesterday. I said I was going to be here yesterday on Sunday Fuel. And you know what? I got so caught up with working and programming, just plumb forgot. Luckily, nothing big happened other than a 1,000 point reversal in the NASDAQ. Before we continue, let's just make sure that the audio is working here. 1 second here, folks. All right, perfect. So last Friday on After Hours and during the week, I was talking about the negative gamma spirit bomb, right? Now, negative gamma spirit bomb is not just negative gamma, which is what happens in the option space when market makers need to trade in the direction of the puts that are running a profit. This is different than positive gamma, where the market makers would do the opposite in order to reduce volatility. This increases volatility in the option space. That's negative gamma that happens within the market structure. The negative gamma spirit bomb is the idea that people are going to figure this out, either hedge funds or retail traders or government or whatever it is, and they're going to figure this out that we just need to move the option space, the zero DTE option space, and just completely control the market and just cause these massive whipsaws back and forth. But that's not happening yet. We're just seeing what happens in negative gamma regime. So we had the big drawdown in S&P. It was like not S&P, not only the S&P, the NASDAQ, like 5% in like a day. And I was talking about on Traders Post how we could see a 1,000 point reversal all the way back up to where we were after the negative gamma event clears, because then you have negative gamma that happens in the other direction, right? Negative gamma can happen on calls or puts. It could happen with the market moving up or moving down. And so that's what we saw. We didn't see it in 1 day, but we saw it over 2 days, where the NASDAQ went from let's see, what was the actual percentage move here on the NASDAQ? From the lows from 2 days ago, it went up and moved up 5.24%. So basically almost completely erasing the drop that we had last week. This is totally expected. Let me just go ahead and just show my chart real quick so you can see here. So we take a look at the E-minis, which is what I trade. We had this drop that happened here. And where did we fall to? We fell right to these two levels here, this red level, this blue level, which is our levels indicator, our levels indicator that are part of the Sacred Profit flagship package, which is showing unmitigated VWAP levels that were still pending there. And so we hit there, we cleared it, and as soon as that was cleared, we moved up. You might ask, Tom, why do we move down to the one below there? Because that one below there is sort of like, well, actually, we could have moved there, and we might even still move there, but bounces happen at these levels, and it has to do with the option space and how much volume is there and what kind of catalyst we're having and all that sort of thing. So this was an NVIDIA drop, and we had this recovery. So over 2 days, the asset moved back up. Why am I talking about this? It's not really a trading show. This show is all about what happens structurally and within markets. So, 1 moment here. Spot Gamma, which is my tool of choice when looking at this sort of thing. All right, why did you decide to not share anymore? 1 second. All right, we're back. So Spot Gamma is great for this sort of thing. And they were discussing how last week delivered some of the most volatile trading sessions of the year, accelerated by persistent negative gamma each step of the way. Your full weekly Sunday note. And what I loved about this Sunday note, let's see if we can get it pulled up here, is all right, so let's just read it because it's short and super useful. So this is from November 23rd, 2025. Negative gamma fuels extreme volatility. There's really only one way to summarize the past few days. What a week. Markets delivered some of the most extreme intraday swings of the year, culminating in Thursday's violent sell-off and Friday's equally dramatic reversal, one of the sharpest two-day sequences we've seen in 2025. As of Thursday, the S&P 500 was on track for the worst November performance since 2008. However, this turbulence was not shocking for traders watching options dynamics. From the start of the week, SPX Gamma flipped deeply negative across all strikes, setting the stage for outsized movement in either direction as dealers were forced to hedge by trading with price action. While 0DTE vol sellers provided some support early in the week, the overwhelmingly red heat map meant the negative gamma remained dominant. How negative gamma drove last week's turbulence. So the week began with traders cautiously approaching Nvidia's Wednesday earning report. The company represented 4 trillion in market cap and over 7% of the entire S&P 500 complex by weight. Wednesday's VIX expiration, Thursday's NFP jobs data release, and Friday's monthly OPEX each brought additional fuel to the volatility fire. Despite Nvidia's earnings beat and a better than expected jobs report, the options market showed that traders were not out of the woods yet. We reference this in our Thursday pre-market AM note. S&P gamma remains negative across all near-term strikes. If SPX moves back to less than 6,700, we take that as a meaningful risk-off signal. Despite a strong open on Thursday, negative gamma combined with wary trader sentiment to ignite the sharp sell-off at 10:40 a.m. SPX violently dropped 200 points in just over an hour. The negative gamma environment meant that dealer hedging would accelerate this move, using the hero spot gamma. Traders saw that Thursday's sell-off was driven by both 0DTEs and longer-dated put buying. The massive 13 billion negative delta was the largest daily value observed in months, driving SPX down 3.5% intraday. Friday's dramatic reversal showed the flip side of the negative gamma. This is what happened last Friday and then yesterday. Friday's dramatic reversal showed the flip side of negative gamma. Despite wavering at the open, the S&P 500 rallied with another outsized 2% intraday move as traders bought calls, forcing dealers to hedge upwards. Right? So this is forcing, these dealers are not in the markets for directional play. They're there for spread and fees. And so they're forced buyers on forced sellers under the right circumstances. And so this dynamic exists where it's possible for market participants in one way, shape, or form to force market makers to push the price higher or lower. Next week brings an interesting challenge for traders as market rocketed with recently heightened volatility enters a truncated holiday week. Markets close for Thanksgiving on Thursday and will only be open for half-day sessions on Friday. The post OPEX landscape, Thanksgiving week uncertainty. So monthly OPEX on Friday cleared significant positioning from the board, which historically leads to a mean reversion in realized vol, which is what we saw. However, while Friday's rally reversed much of the negative sentiment, this type of volatility surge can deliver an impact that extends beyond OPEX. Negative gamma fueled much of last week's amplified price action, and the negative gamma regime looks to persist into Monday for SPX, which we saw yesterday. Given the compressed trading schedule, this could set markets up for an unusual Thanksgiving week. Due to the holiday time decay factor, traders generally don't enjoy paying for option premiums that will lose value rapidly over a long weekend. However, the shortened week ahead will undoubtedly be haunted by the memory of last week's volatility. The most concerning aspect of Thursday's violent sell-off remains that there is no clear catalyst or event that explains what happened. Let me repeat, there is no clear catalyst or event that explains what happened. There was some massive shock. There wasn't a war. There was no bombs that fell. There was no system failure. There was nothing. It was just the options market. When markets drop without an obvious trigger, it increases uncertainty and can drive tail risk. particularly over quiet weekends when liquidity thins and unexpected news can surface. This is where the ice can be thin and can be cracking, and with low volatility and big moves can occur if there's a catalyst that shows up. The lack of a clear catalyst for the sell-off means traders may need to be more cautious than usual. The historical playbook suggests buying the dip and fading the volatility, but the unclear fundamental driver introduces additional uncertainty into that trade. Fascinating, fascinating. What a world we live in here. So you really want to be paying attention to negative gamma as a driving force for the short term if you're in these markets. All right, I just want to bring that up because that's been top of my mind for a clip now. A couple of the things that's been happening over the last couple of days. This was a video that, or an interview that Scott Bessent, Treasury Secretary, talked about. He was asking about a $2,000 dividend and if that would be inflationary. And just listen to what he says here.
Every day, and my prediction is that first quarter, second quarter, what we're going to see is we have brought the inflation down, it is curving down, and real income, the other side of that equation is real income growth, and we are going to see this from all this investment.
Would a $2,000 tariff dividend check going to people be inflationary?
Well, there are a lot of things that are going to happen next year.
Is that one of them?
And that could be one of them. And again, maybe we could persuade Americans to save that, because one of the things that's going to happen next year is the Trump accounts. Every child who was born from January 1st for the next 3 years is going to get a government account that goes into the stock market. So every American child born for the next 3 years, starting January 1st, is going to have that. They can take it out when they're 18. They're going to learn the power of compounding, and there's going to be a lot of financial literacy around that. And I think the reason that we saw kind of the disastrous election in New York is young people don't feel like they have a stake in the economy. So we want to give them a stake in the economy.
We know that.
All right. So let's just put that on the board here. The idea that the reason why the Trump administration is opening up accounts for children born over the next 3 years in order for them to become more financially literate when they're 18 is hogwash. That's clearly not why they're doing that. What a weird thing. You'd imagine that there'd be a bill that would have some sort of bipartisan thing in order to have this continue going from term to term in order to increase financial literacy, and it would be joined with all kinds of other things. What's this idea that the government's going to put money inside of an account for these people that they can't spend, that the parents can't spend, and it's it'll be there until for the next 15 years. Right. Let's Right, of course. Yeah, I believe that. Can you imagine if one of these parents and you go through some sort of medical issue or some sort of issue with a kid or what have you, and you go, okay, can we take that money out? There's an emergency. Billy needs to have, emergency heart transplant, and they go, well, no, because it's not covered. It's got to be there until they're 18 years old. That's going to be crazy. Anyways, neither here nor there. They're doing that because they need money into the stock market. They need money to go into the stock market. And they have to find all kinds of different ways in order to do so. So now they could have thousands of children, thousands of accounts that are opened, and an excuse just funnel money directly into the stock market. And this is on the heels of the question about the $2,000 dividend check, right? This idea that the tariffs have generated such a return that there's going to be a dividend provided to the population. And he goes, well, maybe we can encourage them to save it because we'll be saving on their behalf or what have you. It seems sort of convoluted, forced. I'm not surprised he's saying this with on this channel as opposed to on somewhere else, but that's very loose and very wishful thinking that the Americans won't spend the $2,000 as if they could just hold on to that. No, it's going to be inflationary, and if they're going to send $2,000 check now, chances are they're going to send more money later on, or at least up until the midterms. Guess Trump can't be elected again, allegedly. So they're sending money into the stock market. That's the goal. Stock market go up and to the right, up and to the right. These dips, not financial advice, do your own research, but they must be bought, right? Because this is the way that that the powers that be are taking money from the lesser and giving it to those who, taking the money from those who don't have and giving it to those who do have. And it's definitely going to be inflationary, and we're going to have another bout of that. How high that is, I don't know. But if you're not exposed to markets and you're not beating the inflationary impulse by being in high performing assets that are also um, eh, that they match inflation, but they also overperform over that. Uh, I don't know. I don't know what you're going to do. It's a trader's market. It's you got to be exposed to markets. All right. A couple of things that happen. All right. So there was this whole thing going around about the Genius Act, the crypto regulation designed to funnel money into the treasury market through stablecoins. And Jim Bianco comes in because the idea is that every stablecoin would need to be backed 100% by U.S. treasuries. And then Jim yesterday had a great Mr. Bianco had a great post elucidating a little bit of what that meant. So the argument in the post is commonly said, but not entirely accurate. The Genius Act says stablecoins are backed one for one by treasury bills. So increased stablecoin issuance creates demand for treasuries and lower interest rates. So where does the money come from to purchase a stablecoin? Suppose the funds are already in the financial system, a bank account, money market fund. In that case, it's just a transfer from one account that is backed by government securities to another account backed by government securities. The net change in treasury demand is zero. Every American buying stablecoins is not increasing treasury demand. If it comes from outside the US and is denominated in a foreign currency, they could, in theory, create new demand for treasuries in dollars. How much of this still exists? Tether has been around for almost 12 years. People in developing nations were not waiting for the Genius Act to have the confidence to put their life savings into stablecoins. If they were going to do this, they moved to Tether many years ago because its risks were lower than those of their unstable national currency and unsafe banking system. Further, this argument that the Genius Act was secretly concocted to create treasury demand is part of the reason this bill is not good for the crypto community. It was not to make stablecoins a better version of the US dollar in regulated financial accounts. Instead, it is a way for the TradFi system to assume control of these stablecoins for its own selfless reasons, like funding a bloated government and making sure they cannot compete with bank deposit accounts by not allowing interest to be passed to the stablecoin owner, which is rough. You really want that. If Blockbuster had bought Netflix in the early days, it would have killed it. If Yellow Taxi had bought Uber in the early days, it would have killed it. To me, the Genius Act is trying to do this via regulations on stablecoins, trying to kill stablecoins and crypto. That's hard to ignore, especially on the heels of something that happened recently. This is a clip from Congressman Warren Davidson, who says that the U.S. can fund the strategic Bitcoin reserve by accepting tax payments in Bitcoin. Yeah, you heard right.
Introduced the Bitcoin for America Act, which would allow Americans to pay their federal taxes in Bitcoin. Tell us about this.
Well, look, we're talking about affordability. That's just your dollar's been getting crushed. You know, the house that you live in didn't inherently get more valuable. The money that you measure it in got worth less. And gold is another indicator. One of the best performers in the past year, 2 years has been gold. And that's just one of the worst performers has been the dollar. So a lot of people hold other assets. Bitcoin's been one of the big rises over the last 10 years for sure. And you could pay your taxes in Bitcoin and avoid capital gains on that. But the president created a strategic Bitcoin reserve. How do you fund it? Well, having one control point, the treasurer, Secretary of Treasury, control it makes sense. But you can fund it with no government spending just by collecting Bitcoin as payments for taxes. So that's what the Bitcoin for America Act does.
Introduced the Bitcoin for America Act.
All right. So doesn't that sound crazy? That they would allow Bitcoin to be used to pay your taxes is a step towards legal tender. Now, the idea is that, I mean, they don't let you pay your taxes in gold or silver, palladium. They don't pay your taxes in anything like this, but they will let you pay your taxes in Bitcoin. Now, this is just a proposal; it's not passed yet. But let's say this is a conversation that does get passed. They want your Bitcoin, folks. They want your Bitcoin. I mean, the whole point of Bitcoin is for it to be, the whole message for it to be decentralized. And here, the congressman is saying, "Hey, high performing, we're debasing currency. You might want to keep Bitcoin. You can even pay your taxes in it. We can incentivize you that way." It's like, why aren't you having the conversation about getting back on a fiscally sound route? Get your house in order. No longer to debase the currency. Stop being the world reserve currency. Like, why not do that? No, they don't talk about that. This is not the only congressman who did this. The last congressman, who was it? Or was it a senator? Cynthia Loomis, the one who proposed the Bitcoin Strategic Reserve, or the main sponsor for the bill. Again, they keep talking about it like, well, the currency is just losing value, or the debasement is happening, and as the prices are going to go up, and so you're just going to have to own those assets. Excuse me, what? Just stop doing what you're doing. Okay, fine, whatever. I'm not trying to be on my soapbox here, but this is crazy. These are congressmen they're starting to talk about this. They're trying to talk about the idea that Bitcoin could be used as to pay your taxes. Crazy idea. Crazy idea. All right. Look, everything in the government is pointing to that they want the markets to be up and to the right and quick. So you got to ride that train, right? You got to expect that train to be to ride. Now, what's going on with global liquidity, and why is Bitcoin still going down? Well, we have here. There's just a short clip from. Well, it's on banks, so you go take a look at it. But this is basically Michael Howe talking about how global liquidity has quietly doubled from 100 trillion to just shy of 200 trillion over the last period of time. However, we are having a mini dip, a rollover in global liquidity, and we're seeing that reflected in Bitcoin. Whether that means we're at the top of the cycle, whether that means we have another leg higher, we've yet to see, but liquidity is lower. So this is big demand from the government in order to have the stock market go up, but we're really at the dregs right now, and they have to come up with different ways of generating flows of liquidity, not just new dollars, but the flow of liquidity through the system, through commerce, through credit, and the like. So we'll see what the next couple of months leads to. But if I was going to bet on anything, I would bet that the powers that be are going to figure out a way of getting more money to be flowed around. And if that requires drastic measures, well, that's what they'll do. I've never seen them do anything less. That's it for today's Daily Bread. I've been Tom Hartman, and I'll be back tomorrow with even more news. Unless, of course, I forget. I won't forget. I'll remember.